Welcome to TMS Insights December 2014 to wind up what's been another interesting year for the market. Jeremy Hook and Ben Clark to bring you the update for the last time this year, Ben.
Yeah, and it's been a pretty reasonable year.
It's been interesting, hasn't it? I guess, probably we've been glad to be underweight resources and our industrial stocks have done well. Dividends have been important.
Yep.
There's been some good stories, but probably some people have had some tougher years as well.
Yeah, well, when you look at I think the market's actually sort of flat to slightly down for the year to date, and hopefully we'll get that Santa rally into the end of this month, and we'll see a slightly positive return for the year. But there's been, obviously some big macro themes that have occurred during the year, which will affect the year ahead that we want to talk about. And
we'll talk about the year ahead in 2015. In a moment, because it's obviously of more interest than reflecting on the recent past. But there's been some big news. I think we heard just now on the Murray review into the financial services industry, and some really quite interesting and far-reaching findings potentially.
Yes, absolutely. I think a few points to make on this. Firstly, this review has been done for the last 9 months. We're all well aware it was in the works. I think some of the major findings haven't been a great surprise. They've been well flagged to the media and by David Murray to the market. And we saw the reaction yesterday in that a lot of the bank stocks actually went up despite the news that came out. I think that the main issue is the banks will have to hold more capital.
Yes.
That's a recommendation from Murray to the government. We don't know how far the government will go in terms of executing that and over what time span that will be done. So it's still quite unclear, but I think the reaction yesterday probably suggested that there was a bit of relief that it could have been worse.
Yes, that's right. And just to clarify, the key recommendations that holding more capital is good for the banks ultimately. It preserves their position. Only big, strong companies can raise extra capital.
Right.
But it may have an impact on their return on equity.
Right. And we've put up a chart here that we just wanted to show to clients because I think there can always be some confusion as to what drives share prices. And return on equity is a very key measure in terms of why share prices do better than others, potentially.
And it's got nothing to do with the actual return of holding the shares.
No.
It's the actual profit that is generated on shareholder funds. And as you can see from the chart there, that Commonwealth Bank is the outstanding return on equity in the banking space.
Absolutely. And one thing that these measures will force is the bank's return on equity will potentially fall.
Yes.
And so there's potentially a trade-off here where the future returns that the banks generate might not be quite as strong as they have in the past because they're having to hold more capital and that will reduce returns on equity. But at the same time, the banks will become safer vehicles to invest in.
That's right.
Because they've got more liquid assets on their balance sheets.
Yeah, so it may be a small negative, but nothing of any great magnitude and nothing that would change it. What it might though do, Ben, is level out the playing field somewhat.
Right.
Particularly because banks like Commonwealth, and again the chart did show, that the higher return on equity led to a greater price to book, so a greater rating by the market. And again, that equates to higher pricing.
Right.
Whereas the smaller banks haven't got the benefit of that higher pricing. Now, if they can have a more even sort of return on equity across the banks, we may see some better performance in share price terms coming from banks in catch-up phase.
Absolutely. And you look at NAB and the return on equity that's being generated there. This is the other thing that moves share prices is when you see that sort of return to its industry peers and it's trading on a discount, then there could be a re-rating there that actually sees that outperform. I think also the banks realistically will try and pass a lot of these measures onto their customers. And David Murray, he was on the 7:30 report last night, actually said that if the banks lifted their interest rates across their mortgage book by 3 basis points, that's 0.03%, it covers a 1% increase in their Tier 1 capital ratio.
Yeah, that's it.
I think you can see that happening.
Right. Yeah. And that could be just by failing to pass on an RBA cut in full, and they do that regularly. So maybe not as big a deal as the hullabaloo on Sunday that came out. So that was the Murray review, and it was obviously very important. I guess in a macro sense, Ben, there's been some things going on that clearly have some explanation required. oil price, iron ore price, currency, all under pressure here.
Yep.
Commodities, we're a commodity country.
Yep.
How does this play out? Because there has to be a ramification for investment markets.
Absolutely. And where this has probably had the biggest ramification is in the bond market. And this is what we want to show another chart here, because this is certainly not data I think you see regularly.
No, people don't get this. They
Right.
don't see this often. And,
Yep.
and it's really important because it's what we price all the equities on.
Yep.
And it actually dictates performance in the share market, bond relativity.
Absolutely.
And so this chart showing the 10-year bond,
Yep.
it's been on a progressive track down all year.
Yep, so it's not showing the price of the 10-year bond, it's showing that the yield that the 10-year Australian government bond is paying, which is almost seen as the risk-free rate
Yes.
by the market. And what this shows us quite clearly is that the bond market is pricing a period of A, low growth in the local economy, and B, and maybe more importantly to our clients, is a period of very low rates historically. We're seeing the 5-year bond rate is now below the current cash rate, and the 10-year bond rate is indicating that there might only be one interest rate rise, or the average interest rate will be, sort of 3% over the next 10 years,
right.
which is
Phenomenal, yeah.
it is incredible times.
And of its own, that is a healthy thing for the share market. We don't want to see plummet too much further because it again could show signs of more worrying low growth. But look, we think what it spells for the market is a healthy backdrop to a year where we can see some earnings growth, but not across the board. We still have to be stock specific and have to look at the individual companies, but also that the yield argument will be very true in the front half of 2015.
Absolutely, and I think looking ahead and what we believe will do well next year, the yield trade has been 2 or 3 years progressing now, and if you're looking at what's going on in bond markets, you would have to say that it's setting us up for another year where high dividend, conservative paying companies are going to have reasonable performance, I think. As money continues to come out of cash, as people slowly catch on to these themes we're discussing and look for alternatives as to what they can invest in. Also bear in mind that a lot of those companies, those safer companies, particularly in places like the infrastructure area, have reasonable levels of debt that are priced over long-term bond rates. So their cash costs of running their businesses are falling, whereas revenues should continue to rise, and that's actually a positive for those sort of businesses as well.
And just before we come to the year ahead, Medibank and the IPO process, it was busy in the back quarter of the year with a lot of IPOs. Medibank was a good one.
Yeah, I mean, it probably didn't set the world alight as much as some said it would, but I think it's up sort of 7.5% in a couple of weeks, which is still a handy rate of return, and we think it'll be well supported. And as the management team brings out its plans for the company to the market, fair to say we see further upside from here.
And I think the other point to make is there's been quite a few IPOs. We've looked at a number, and some of them haven't done that well. They've been a bit overpriced, private equity sellers and the like. So there's been some good things to avoid there. But coming to 2015, again, we always like to give a little bit of an idea and some guidance. You have a fair bit of visibility at the front end of the year. It can be harder to work out where everything will be this time next year. But Ben, I think we're setting ourselves up for a reasonable year 2015.
I think so too. I mean, I think 2015 I think will be reasonably similar to 14 in that there are parts of the markets that you don't want to be involved in. The market as a whole you wouldn't say is offering great levels of earnings growth, and therefore I think there's going to be parts or pockets of the markets or individual shares that have got business models or there are industries that are in growth phase that should do well, and there are other parts that you still want to avoid. So in terms of picking where's the overall market going to finish up, probably not so relevant to us. Because there's a lot of industries we're not involved in.
It's important what you're in and what you're not in, and that will again be our focus, is trying to bring good stocks in the right space. But we think it begins on a reasonable footing, and the year should actually pan out pretty well. That bond setting and a little bit of earnings growth and a basically sound economy, notwithstanding we're in transition from that mining phase into a more housing-led construction phase. things will be basically pretty good here in Australia in the front half of 2015.
I think so.
Yeah. And that's all we've got time for today. Thanks for your attention and time today. And on behalf of everybody at TMS Capital, it's Jeremy Hook and Ben Clark wishing you a very Merry Christmas.